results. I'm happy and delighted to share with all of you that we've had our historically best ever quarter on almost all criteria. Certainly on the net profit side, we hit 704 crores as net profit for the quarter. And internally, we discussed, a few years ago, that was the profit of the bank at some point in time. So for a full year, so delighted that we're doing that in a quarter, and I do hope this is the harbinger of many more such outcomes. The overall profit numbers were helped and were inspired by a range of developments across the spectrum. It was not on account of any one particular business or one particular line of business doing well. It's across the entire spectrum. We saw corporate doing well, we saw retail doing well, we saw quarter-on-quarter and year-on-year growth on most dimensions you may have noticed. What is heartening is that the interest income growth has kept pace with the credit growth of the bank, both at about 19% Y-on-Y. As a consequence, the operating profit on a Y-on-Y basis moved up 33%. Net NPA and gross NPA, which traditionally have been the stronghold of the bank, continues to get even stronger. Gross and net improved quite materially. Gross NPA dropped to 2.46% and net NPA improved to 0.78%. And this quarter, we made a material increase in our provision coverage ratio. And that again was sort of confidence that the portfolio quality the balance sheet is being strengthened further. And despite increasing our provisions for credit, we were able to deliver the highest net profits for the quarter. Other income, largely very diversified, broad-based, grew sequentially and on a Y-on-Y basis. And this did not have any particular influence of one-off. It's the organic structural growth, more credit disbursement, more liability origination, all have resulted in fee income expansion. So as you would notice, this is one of a very all-round performance by the bank. Like I pointed out, it's our highest ever net profit in the course of the way the bank has conducted itself. And return ratios as a consequence of this have been at very, what shall I say, encouraging trends. ROA at 1.2 and ROE close to 14%. So I'd pause here. Happy to take questions with the introduction. You may have had a chance to go through our numbers. Me and the entire senior team is there. So happy to clarify, give you nuanced insights on any area that you may want to hear about. Thank you.
Thank you, sir. Now I would request the participants to unmute themselves and introduce before posing the questions.
No questions.
Hello, sir.
Hi.
Am I audible?
Yes, you are.
Yeah, I'm Manoj Mathi from Malayalam Manorama.
Yeah, Manoj.
Is this the highest? Manoj Mathi from Malayalam Manorama.
Yeah, go ahead, Manoj.
Yeah, is it the highest ever Q2 revenue for you?
It is the highest ever profit ever in the history of the bank for any quarter, not only for Q2.
Oh, that's great.
It's the highest ever on revenue and on profit.
Oh, that's good. Thank you, sir.
Welcome.
Good afternoon, sir. I am Prabhakaran from Times of Ireland. You just said that you had the highest ever profit. Can you point out any particular reason, any particular contributing factor for this highest ever profit? Any particular reason? A single reason can you point out?
No, like I said, Prabhakaran, the good news is it's not any one. It's structurally improving on every dimension, whether it's the growth in the right areas, whether it is the credit quality management and efficiency management. So I'm happy that it's been broad-based and not driven by any one particular one-off gains. So as you can see, every quarter for many years, the bank has consistently performed. And it's no surprise that this quarter is the highest compared to last quarter. At the same time, I said that was the highest. So we hope we will be in a position to continuously keep saying that, because structurally underlying, consistent, regular, credible growth is happening.
Okay, thank you, sir.
Welcome.
Hi, sir. So Nupur here from Reuters.
Yes.
So I just wanted to understand that, total advances have grown by about close to 20%, whereas deposits have grown by nearly about close to 10%. I just wanted to understand, there's a significant gap between the deposit growth and the advances growth. If you could just provide any guidance on, how much is both advances and deposits expected to grow, and also if there are any other steps that you're taking for deposit mobilization in the coming quarters?
I think, Nupur, you've been tracking us for many years. We are a fairly strong liability franchise and very granular in nature. And when we have stepped up credit growth, it's not like we've lost sight on deposits, but our credit deposit ratio usually has been in the lower side of the below 80 mark. So we have potential to go up to 84, 85%, which is where we are at this point in time. So we calibrate our deposit growth to ensure that our credit requirements are well funded. At this point in time, as you notice, the credit growth is in the high teens, and we believe for the full year too, that will remain around the high teens. So between credit deposit growth of somewhere in the early teens or pre-teens, as they say, and the various other avenues available for originating deposits and a CD ratio of somewhere in the mid 80s, we believe we'll be well funded and we will be able to deliver both an optimal balance sheet, managing our cost of resources, and importantly, ensuring that our CD ratio is at the right level. So somewhere in the early teens or pre-teens in deposit growth, high teens in credit growth, which has been the trend now for some time. And we don't largely depend on bulk deposits. Ours is very granular in structure. You may have noticed our our deposits is largely retail, and well over 90% of the book is retail and granular.
Right, fair enough, sir. So I also just wanted an understanding on, how the FCNRB deposits have done after there was a rate increase in that segment. Just wanted to understand how was the mobilization there. If there's any number that you could please provide us.
I think I've mentioned in the past, we are not a big FCNRB deposit origination machine. Ours is granular retail liabilities that come largely in rupee. And FCNRB has a different characteristic, so we don't pursue that very aggressively. That said, we have grown, but nothing too material.
Right, fair enough, sir. Thanks.
Welcome.
Harsh, would you like to take it?
Yeah, hi. So hi, sir. Harsh from ET now. So quick
Harsh.
couple of questions. Hi. So firstly, congratulations on a fantastic quarter. So you had guided for NIMS just below that 3.3% mark, and now that it's hit 3.3, at least in FY23, would you be looking at to up that guidance by maybe 5 bips or so? How are you looking at it?
Harsh, thank you. Yes, so we have to look at it for the quarter, it's 330. As you know, we began the year at 320 odd. So the blended number for the full year will reflect this increase, and we think somewhere in the 327 or something will be the full year blended number, considering that the first quarter had some slack. Between 327 and 330 will be the full year NIM. To that extent, yes, we are giving an upward guidance of almost 4-5 basis points.
Right, sir. So my second question is on your cost to income. That's dropped dramatically. Now you've guided for two things in the past. One is that branch expansion is going to happen going forward, at least over the next 2 to 3 years. Please correct me if I'm wrong. And the other piece, of course, is that with that branch expansion will come higher costs. So are you seeing the cost to income starting to trend lower? If not this year, then in the next year, are you seeing that, or are you seeing it to be steady? And at what level do you see it at?
Our cost income ratio we had guided would get below 50, and we would track that, and only that we advanced it by a year because of the strong income track record. We've never been very extravagant on costs. As the income traction increases, the cost income ratio tends to be in the sub 50, and this quarter we did come below 50, and we think even in Q2 we had 25 new branches that we added. So we are very much in the branch expansion territory. We've said that in a 3-year period, we'll expand our network by about 25%. If all goes well, we may even upfront some of that growth. That said, I think we are still sticking to our 50%, trending to 48 over a 2-year period as our cost income guidance.
Right. And my last question is going to be on advances growth. So if you can guide maybe a year or two forward as to how you see advances growth. This time was extremely strong, of course, but do you continue to see that over the next year or two?
For the period we have line of sight, which is, I would think, 2 quarters out. Yes, we think 18% to 20%, high teens as I've guided, is something that we are holding on to. We will see how things unfold. FY24 could be a new ball game altogether. There are lots of moving parts, but we remain optimistic that we will be able to grow, and we will grow at least 20-25% higher than the industry run rates.
Hello,
Right,
sir.
sir. Thank you.
Hi, sir. You have completed 12 years as MD and CEO of the Fed Bank. How do you feel now? It's a long journey.
I still feel like it's day one. I still have the excitement to do this for a few more years.
Yeah, still fresh.
I hope so.
Yeah, great.
Thank
Congrats
you.
for that, sir. Thank you.
Thank you so much. Thank you, Manoj.
This is Atmadeep from Economic Times. Am I audible?
Yes, Atmadeep. Very much. Very much.
Okay. I would like to know that what is the ratio of your loans which are linked to repo, and has the transmission has completed in your bank?
Yeah, around 65% of the book is linked to external benchmark and or MCLR. And that transmission happens, a large part of it happens every time the repo rate changes. And so to that extent, yes.
And what about the rest 30%?
Sorry, come again?
Yeah, on the rest, Atmadeep, on the rest, 25% is about fixed. And then we have small percentages in FX linked and base rate and staff and other things.
Mr. Venkat, you're on mute, I think.
No, he mentioned, apart from the 65%, around 25% is fixed, and the remaining is the FX linked or staff loans and stuff like that. So to that extent, 2/3 of the book is external benchmark or repo linked, and that moves, or MCLR, and that moves in tandem with the rate increases or rate decreases at some point in time.
Okay, thank you.
Welcome.
Hi, so here from Money Control. Congrats on the results. Just to take the question on your target for credit growth. Last quarter we spoke. You said 15% credit growth is your aim, if I'm not wrong, for FY23. Does that still hold? And question, a follow up to that is that how would you want to fund this kind of credit growth? Would you just plainly look at deposit mobilization, or are you looking to go to the market for funds?
I think I mentioned on the last call, at the end of the last quarter, that our credit growth in the high teens is what we are pursuing, and we are on course for that, and that guidance continues, and that's our aspiration. I also mentioned that our deposit growth is fairly consistent and granular, and we believe, like I mentioned in even today's call, somewhere in the early, pre-teens is very much on the cards. We'll try and dial that up further. There is a war for deposits, as all of us know. And equally, we have opportunities to borrow at the right price, and we have enough room in our CD ratio to lend. So a combination of things will ensure that our book is capable of growing at these kind of run rates.
Okay, sir. Thank you.
Welcome. Welcome.
Hi, sir. Nupur here again. Just a couple of follow-up questions, please. As you yourself mentioned that there's a war for deposits going on right now, and this was some part of it. I did touch upon my earlier question as well. Just once again wanted to understand, that considering that there is a significant difference between credit and deposit growth right now, and also as you mentioned, there is a war for deposit going on. If you could just detail out some plans, and how do you plan to mobilize more deposits going ahead? Because this is one crucial item that needs consideration right now. And also, second thing, just wanted to check on any capital raising plans. Right now, I do understand that CR is about close to 14%, roughly there, but just wanted to understand if there are any plans in capital raise.
Let me answer the second question first. On the capital raise, I think I mentioned last quarter on the call, we have none for FY23 lined up. If the current momentum and trend line continues, sometime in calendar 23, we could consider, but at this point in time, there's nothing that we are working on. And on deposits, I think there's a part of the deposit structure for all banks, and as it is for us, is elastic to price, right? And there's an opportunity that we will work on. Second is we have very attractive offerings on our various segmented offerings like Celesta and Imperio and our other sort of liability offerings, which are targeted at different segments. And often these are not just pricing, these are packaging in terms of a bundle of offers. So the retail team, Shalini is there on the call, can expand, but we have a bunch of products and offerings that target different segments of the market, and we are able to scale. As you know, we have a very large fintech partnership that is pouring in, and we have been a constant magnet for non-resident deposits, and that's I'm happy to report that our non-resident remittances, we are 22% of India's remittances. Last quarter we were 21. So we continue to be a very dominant player in that corridor. So a combination of product offerings, distribution enhancement, because we're adding up branches quite materially, and the segmented offerings that we make, we're pleased that our deposit structure and growth will be responsibly grown. We wouldn't be very courageous to throw rates around. So we'll be practical about it to meet our overall credit requirements. Shalini, you want to add?
I think you've covered everything, Shyam, but just to add, Nupur, one additional item is over the last couple of years, we've done a lot of investment into the whole relationship management process and capability and capacity. And these relationship managers are designed to approach, the high net worth, the semi-high net worth, where they pitch our propositions like Celesta, Imperio. We are seeing some good growth in that, both on the resident side as well as the non-resident side, where we have relationship managers managing it. So distribution through branches, distribution through relationship managers, strong product and segment propositions, a combination of all this is helping us already. As Shyam said, term deposits are very elastic to price. In the event we believe that we need to garner that kind of thing, we will always look at price. But that's really something that we do, very responsibly. Ours is very, very granular retail growth coming from the franchise. Nupur.
Right. Thanks, ma'am. Thanks, sir.
Welcome.
Welcome.
Hi, sir. This is Ankur Mishra from ET now. Am I audible?
Yes, Ankur.
Yes, I wanted to ask what has been the reason for growth in the other income, which is up around 23%, if I can see. And can you also detail the constituents of it? And the second question I wanted to ask, is there any intention or talks for any M&A which has happened in the past, or is there a likelihood, if you can clear on there? Thank you.
The second one is easy to answer, right? I mean, even if there was ever a talk, you think we will go ahead and announce like this. So rest assured there is none. And if there is, we will certainly have the right platform to share. The first one is, I think I mentioned at the beginning of the call, it's there in our investor deck also. Good. The growth has been broad-based, but as the credit picks up, as our distribution in various businesses pick up, you will see fee income expand, say, in loan processing. For example, between 2 quarters, the loan processing fee went up 25 crores. What was 100 crores is 125 crores this quarter. And businesses that are exchange, commission, brokerage, our fee income on distribution of third-party products have grown up about 50 crores. So these two itself constitute 75 crores growth on a sequential basis. Then FX has been a very strong performer by another 30 crores. So you can see between 2 quarters, these three lines have added about almost 100 crores. I think Venkat wants to chip in.
Yeah, just on the other income point which you asked, that line largely represents recoveries on assets previously written off, then the dividends which we get from subsidiaries and associates and all that. So that's the reason why you see a big jump on that line.
I think the overall other income, if I can just add, Ankur, to what Shyam said, other income also, we've seen a lot of good traction on credit cards and debit cards, both of which help us to contribute on the interchange line. So it's not one item, but it's a combination of a lot of items, and some of the details are in the investor pack, Ankur.
Okay, thank you so much.
Welcome.
Hi, sir. This is Roshan from Madhubhumi.
Yes,
Last
Roshan.
month, there was some reports that Axis Bank is going to acquire Federal Bank. Is there any talk still going on?
That's a new name.
Roshan is a new name I'm hearing, but in my 12 years, I have been bought and sold 5 times. So, right. So I think
even Reliance
yeah,
was there.
you've been covering us for many years. You've heard this story
Right.
many times.
Yeah.
So this will play on. This record will play for a few more years. Don't worry.
And one more question, I think Shalini ma'am can answer that. You have tied up with Epify. And how many accounts you have already opened through that partnership?
So Roshan, thanks for the question. We have two savings account partnerships, both Epify and Jupiter, through which we get accounts. You'll see some of the details in the investor pack. Without going into actual numbers, etc., I can tell you that they've considerably enhanced our distribution, about 3 times of what we would have done in an organic phase. We're getting through these inorganic accounts. Some of the details are there in the investor pack, and for various reasons, the actual number is something that we would want to hold on to right now. But the number, the growth trajectory is to be seen very clearly. They add considerable heft onto our distribution, Roshan. Yeah.
Thank you, madam.
Hi. This. Hello.
Yes, Anshika.
Yes, please go
We
ahead.
can hear you.
Hello. This is.
Anshika, we went.
Can you hear
Please
me?
go ahead.
Hi. So, Shalini, this is a follow-up question on the fintech partnerships that you talked about. But this is Aarti from Mint. I cover fintech. So, on Epify and Jupiter. So you're saying that they have kind of contributed like 3x to what you would have done, without those partnerships. Can you tell me, like, in terms of value of those deposits, is that significant enough for the bank?
So I think, Aarti, the way to look at it is, one, these are digitally oriented, kind of digitally savvy customers of a profile which normally wouldn't come through the branch network. So we tend to attract a very different profile of customers through our relationships with Epify and Jupiter. Two, they're relatively more recent relationships. Both of them about a year and 3 months old. And therefore, as you well understand, a balance build up in any of the fintech partnerships takes a fair amount. In any organic sourcing of fintech partnerships will take time. It's through stickiness and through product propositions, etc., that they will come. So in terms of contribution from an incremental growth perspective on the savings account, we are seeing traction from both the partnerships. Rough and ready, about 10 to 15% of our incremental growth comes on resident saving comes from these. We are targeting for it to increase. In its contribution to the overall base, Aarti, I have a very large base, right? Between resident, non-resident, I have a fairly large base. So to that extent, the addition on that is not going to be material in the immediate term. But over a 3 to 5 year period, it will definitely go up, Aarti.
One more question, last question maybe. So this is about deposit, right, on the neo banking side. Could you please tell me, like, about the on the credit card side, on the personal loan side of the partnerships, how are fintechs doing for the bank? So I think you have one partnership with one card. You had one, right?
Yeah. Yeah, we
So
do have one. Yeah.
so
Yeah.
so have you partnered with others as well in the market, since a lot of players are looking into credit card partnerships nowadays?
Yeah. So, I think we do have on credit cards a fairly big partnership with FPL One Card. That's been just completed a year of its partnership with us and doing well from a growth perspective. As you rightly said, there are lots of players in the market who are keen to kind of associate with us on credit cards. We're working with some of them. I think we're working through the contours of how the deals will be, how how the risk appetite looks at it, how the proposition would look at, etc. We're also doing some technology enhancements at our end to be able to kind of take on more of these partnerships. So both of these are work in progress. I think by the time we come into the results for the next quarter and the quarter after that, you will see some significant movements on that front. But you're right, there are partners out there who are keen and some very good names. Having said that, you will also notice in the investor deck that we've gone live with our personal loan partnership with Paisa Bazaar. It's covered in our investor deck. We just went live recently in September, and we do believe that that will scale up. That's a personal loan proposition, but both credit cards and personal loans we are working on.
So thank you so much.
Thank you, Aarti.
Hi, Shyam sir. This is Gopika here.
Yeah, Gopika.
I just want to understand, has the growth in NRE deposits been slow in the first quarter, and the second quarter we've been seeing very muted growth? Is there any particular reason you're seeing? Is there any particular reason behind this?
NR, let me break it into two parts. One is the remittances continuously strong or stronger. Whether it stays as deposits or not is, I think, both seasonal and situational. Seasonal, typically around Onam and thereafter it tends to slow down. Situational, a lot of them are putting money into property and or small businesses. So deposits growth relative to past periods is lower. Remittance growth is stronger.
Okay. And with regards to your wholesale deposit growth, um, uh, is it mostly working capital loans? Can you describe what kind of credit is picking up?
You mean wholesale, not deposit, you mean credit growth?
Credit growth, yes.
Yeah, Harsh is there, so he can take it.
Yeah, hi. Now we are seeing growth both. Largely, it's come on the working capital side, but we are seeing a lot of activity happening even on the term side because interest for capex has increased substantially in the last 2 quarters. So as of now, it's being driven. It's fairly wide and broad based across sectors.
And is this mostly coming from the PSUs or is it private?
No, it's private sector.
Okay. And one last question on the FedFina IPO. What is the status of this?
You will know when we are getting close to the IPO. At this point in time, all I can say is the DRHP has been approved. The company is doing roadshows, talking to prospective investors, and I think timing is all situational. But they're gauging the interest levels. There's a fair amount of conversations underway.
But are you hoping that it'll be closed before the end of the year?
We have 1 full year from SEBI approval. SEBI approval came somewhere in June. So between June 22 and June 23 is 1 full year. We think somewhere in the interim is most likely.
Sure. Thanks. Thank you, sir.
Yeah.
Hi, sir. This is Anshika from Hindu Business Line. I wanted to check regarding retail slippages which have remained elevated this quarter. Last quarter, you mentioned that a bulk of them are secured, of course, but just wanted to get some understanding in terms of your guidance on recoveries and how you're looking at the retail loan book, especially. Also, if you could give some color on the restructured book under the retail book, because the retail loan is a segment that you are looking very positively on, especially the personal loan and card segment.
I thought, Anshika, this quarter the retail slippages have almost halved.
Yes, but they're still elevated as compared to other segments.
No, it's not. As a percentage of the denominator, it's consistent. In fact, we've had quarters that are 78 to 85 to 140 crores of slippages. This quarter was lower. So I don't see that as an elevator. In fact, I would think in the current context, it's a very strong performance. And further,
Okay.
like you mentioned, it's as we don't do unsecured. Unsecured is a
Yeah.
very small part as yet. It's a secured book and looking good. So remind me the second part of your question, Anshika.
So just some guidance on the restructured book and on recoveries overall in general under the retail book.
You must have observed our recoveries and upgrades was very strong this quarter.
Yes.
And we think, particularly when you have a secured book and it's a portfolio management capability, over time that continuously keeps feeding itself, right? So it's nothing to be too alarmed by. Restructured book is behaving way better than we thought it would at the time of COVID at its peak, which is why
Right.
we made material provisions,
Hmm.
and we are pleased that that progress is good, and we have not released the provisions either.
Okay. Thank you.
Thank you so much.
Debashri, you may want to check. Ajay Ramanathan has had his hand raised, but I don't know if he's not been able to ask.
Ajay sir, would you like to ask a question? Not sure. It could be an error also. Anybody else would like to ask any question to the management?
Hello. Sir, Shashank here from Financial Express. Sir, I wanted to ask a question on NIMs you spoke about earlier, but with the interest rates on deposits rising, do you think you'll be able to hold the NIMs, or if you can give any guidance from that point of view?
So, Shashank, I think very beginning of the call, I did say the blended NIM for the bank for the full year somewhere between 327, 330. And that is after considering all the points that you just mentioned. Yeah.
Yes,
Thank you, sir. Anyone else would like to ask any question?
Good. All questions addressed. Okay.
Sir, there is a question in the chat box. I'll read that out. This is from Anil Kumar Sharma from Kerala Kumudi. The question is, interest rates have been very low for the past 3 years. Now the rates are rising sharply. How do you think this will impact the banking industry?
I think his question is valid. It is true that interest rates are rising and is set to rise. But I think it has to be seen at a more strategic level, whether for a bank, there are two parts. One, you lend at a particular rate and you collect deposits at a particular rate, and both are going up. So to that extent, the banks manage it well. But I think we have to look at it as the environmental impact. There is a certain degree of pent-up demand which is coming through in the country, and that I guess will keep sort of continuing to grow. And I don't believe interest rate is the only driver of everything, right? If it's elevated interest rates and there's growth all along, then you're able to deal with that. So I think the focus is on growth and consistency of growth and more broad-based growth, which is what the various initiatives of the regulators, the government is all around stimulating growth, creating an environment that is conducive to growth. And with the global markets being where they are, I think domestic economy has to fire, and that's where the focus is. So that's what I would say. Ashutosh, you want to give any closing comments on that? You can add, please.
Yeah, I think when interest rates were negative or even closer to zero, despite the funds being cheaply available and all, we saw recessions all over the world. So I think, yes, there is a connection with when interest rates are moderate, the opportunity to grow is more because the cost of capital is lower. It's not easy growth to come up and all. So I think what you need is basically the demand for the new investment, higher capacity utilization. So when you have higher availment of credit, even if it is at a higher cost, you may fine, I think the growth would happen, and that certainly helps the banking industry. So banks, would flourish when there is a demand of capital, when there is a demand for loans and all. And for funding that demand and all, they definitely would be looking at compensating the savers. So savers need to be compensated, and there is nothing wrong, if the higher interest rates are offered to the depositors.
Thank you, sir. I have an additional question from Mr. Ajay Ramanathan. He said that, just a clarification, are we likely to see credit growth at 18 to 20% in FY23? And what would be the breakup of wholesale credit and retail credit?
May I take this? Okay. Go ahead, Shyam.
No, we've mentioned that it will be in the high teens, and we'll continue to do that. The mix of the business is more or less the same, 55, 45, 56, 44. And that's been the trend, and we'll keep it that way. We are broad basing, and all our businesses are doing well and should continue to do well.
Thank you, sir. There's another question. Also, what is the expected deposit growth in FY23? Does pre-teen mean 10 to 12%?
Yeah, I normally in English, pre-teen is 10 to 12%. Yeah.
So one question, when do you see this higher interest rate beginning to affect your credit growth? I mean, I know most of the bankers have been quite optimistic about credit growth. But when do you think it will become, you will start worrying about, interest rates?
Gopika, you covered this industry for longer than I worked, so you know it. But I would say it's not just one dimension. I mean, if it's only interest rate, then your question we can answer that more constructively. I think it's growth, the overall demand. As long as the combination of this works, then the cost of money, see, if you're taking a longer tenor loan, let's say, for an extended EMI, then I don't think the borrower is that fussed, provided he knows that his income stream is there and he can grow. So I think we must always look at credit not just as the rate of interest, is the cost of ownership. And cost of ownership is across periods of time, and it'll moderate, because if you borrow at, say, I'm just argument's sake, borrow at 8%, and if it's a variable rate, there will be era when the interest rates will be lower. The 8% may suddenly become 5%. So that's why always borrowing has to be looked at through a longer horizon, through a lens of cost of ownership. Near term, there will be variations. That's how at least I have come to understand, and that's how I explain to our clients. And broadly, there's consensus around it.
Sure.
Okay.
Thank you, sir. We have additional questions coming in my chat box, sir. Sorry, you cannot see it to me privately. So Deepika Delhi Kochi Sijo has a question. If you have any suggestions for the government for changing in policies for banking sector?
I think that's a question best answered after a lot of thought. I would let that pass just now.
Thank you. Anybody else have any questions?
Okay. Fine.
Okay, so would you like to add anything, or should we?
No, I think thank you all for joining, and I'm sure between our answers and our investor deck and our marketing team, you'll be able to get any clarifications that you want. And please communicate the good work to the world. Thank you so much.
Thank you all for your valuable time. Happy Diwali and festivities to all of you, and look forward to see you all very soon. Thank you.
Everybody, happy Diwali, everybody. Thank you.